Hello, everyone. Thank you all for joining us for the Small Cap Insights podcast powered by Darrow Associates. My name is Jack Greenberg. I'll be your host for today. We are a leading full-service investor relations firm that's focused primarily on small cap equities. Joining us on today's episode is Jesse Gamble, a Senior Vice President and Managing Director of Donville Kent. Jesse, welcome to the show. Thanks for coming on.
Yeah, thanks for having me, Jack.
No problem. To start off, can you give us some background on yourself? How did you get involved in investing and ending up at Donville Kent?
So Jason Donville, founder of Donville Kent, actually recruited me out of school. It was kind of an interesting story, but I was doing kind of a senior year project on breaking down ROE, DuPont analysis, and those type of metrics, and that really resonates with how we operate here, how Jason thought about ROE as our main metric and Buffett, et cetera. So we are already at that point, kind of we knew we were kind of viewed the markets in a similar way. And then, yeah, he took me kind of under his wing as the mentor. And then now I've been here for over 14 years and we kind of work day to day. And that's part of our strategy of kind of having, two sets of eyes, two brains, kind of overlooking at all companies at all times.
Great. So yeah, that's a good segment into my next question. You mentioned ROE kind of being one of the green flags that you look for, but what are some of the other qualities that you look for when evaluating potential investment?
Yeah, so obviously you guys are focusing on small caps, and I would say we're not necessarily put ourselves as small cap investors, but we end up owning a lot of small caps because what we're doing is we're looking at companies and we're trying to, and we initially break it down into how much growth, how many units of PE do we have to pay per unit of growth. And if you're looking at that, if you're using ROE as in your sense of your growth as your compounding metric and your PE, what you end up doing is you end up owning a lot of small caps because there's growth there, but then there's usually you can find them when they're cheaper as well. So we look for, we're not looking for upstart companies without, revenues and profits, but we are willing to go very small end if there are high ROE businesses, emerging companies from that side. So we are looking for companies that can compound. So when you're talking about metrics, one of the first things we look at is their unit economics. That's what are they selling? What are they getting? Can they take that profit and redeploy it back into their business at a high rate of return? So if someone's leasing a piece of equipment and they have a 20, 30, 40, whatever percent IRR on that, can they take the cash they generate, make another one, lease it out again, et cetera, something along those lines. So we're looking for compounders, and then we end up owning a lot of small caps.
Got it. Yeah, I really like that strategy. And taking a deeper look at the portfolio, industrial, non-cyclical consumer, and technology companies seem to make up about 85% of the portfolio. Is that kind of an intentional preference for those industries, or just happen to find more companies that meet your criteria in those industries?
Yeah, so I would say we're industry agnostic and also market cap agnostic. We're just trying to find the best way to deploy capital at the highest, the best compounders we can find. And we pretty much don't invest in energy or materials because I would argue by definition those can't be high ROE businesses. But so then where do you find them? You find them a lot in technology, and then even in industrials, we own a lot of industrials. But if you actually look under the hood, there's a lot of technology that's backing those industrials up. That's why they can scale. That's why they have high margins. So not your typical, old school industrials. A lot of these have scalable tech behind them. So when you start mentioning sectors, yeah, I would just say we don't necessarily care, and we just end up owning what we own, and that's how it breaks down.
And to that point, you guys have virtually no overlap with major indices or ETFs. Is that an intentional strategy again, or
No, not intentional. Once something does get into an ETF, and we've had companies that we've owned that happens, that's where you can see a large move in their valuation, right? So if we're trying to balance growth and valuation, a lot of times, that leads to something smaller that's not going to be an index yet, but it will grow into one. And then that's where you get your valuation increase. But again, we don't care if it is in an index or isn't. But a lot of times when we're out visiting these companies, we might this has happened multiple times where management has said, you're the first people to ever come and potential investors and sit down and come to the location and ask us questions. So obviously those companies aren't going to be in ETFs yet. But if they compound at 20% a year, a company can go from small to medium, get into some medium indexes, get into a large index over time. And, we've had that play out too.
Yeah, that makes sense. And, as I'm sure both aware, small cap space is very volatile. How do you balance kind of those short-term market pressures with a longer term conviction in a company?
Yeah, and I would say that's definitely the number one hardest thing when being in small caps. And 2022 was the definition of that,
Hmm.
where that whole market sold off a ton, 50, 60, 70%. Some of these stocks went down, and we would be going through our portfolio, and it was almost every single one of our top 10 investments had a record year and record earnings. Then the following year had a record revenue growth and record earnings, but then the stocks were still down. So what we do is we just stay as close and as knowledgeable about the company as we can. So we always say, know what you own. And if you know what you own, that can actually be an opportunity. But, it's hard for clients to see that much volatility. And I understand it, right? Like our money's in the fund as well. Like we're invested in these names as well. And it's hard to see something go down. But if you understand why, and it's not operationally an issue at the company, it's a stock market phenomenon, and it's not overvalued and it's continuing to compound over time, then that's kind of the volatility you need to stomach, right? Like you can't have everything. You can't have high growth, low valuations, and low volatility like that. That's not a thing, right? You can name everything you want in an investment, but to go out there and find a portfolio of them is really hard, right? So the volatility is definitely the hardest thing to stomach. But again, if you're doing it the right way, I think you get rewarded over time, by taking on that risk.
Yeah, no, I think that's great. And you mentioned having, your money invested in the company. I read that you like when management is also aligned. And how can you kind of tell when management teams are truly aligned and when they're not just kind of talking the talk, so to speak?
Yeah, yeah, it's hard, right? Lots of different companies have different types of compensation schemes, but obviously you want them to have real equity ownership, not options ownership, and you want it to be fairly significant. Where we've found the best success is companies that are founder led, so they see the business as kind of like their baby. So there's definitely that aspect. They're not a hired gun per se. That we see success there. But yeah, there's no right or wrong. I guess there's multiple different ways for them to be bought in, and you kind of have to have that discussion. We like to sit down with management and have the discussion on return on equity, return on investment, IRR, payback periods, and you want the management team, especially the CEO, to know those numbers. I am making X dollars. I can redeploy it into these projects at these IRRs. We say we want them to speak our language. And if they're thinking like that, then they're thinking long term, right? To get a 5-year payback period, like they're thinking 5 years out, 10 years out. They're not just trying to prop up their stock price and have short-term gains, right? So I think having thousands of meetings with CEOs, then the ones that are actually bought in kind of jump off the page versus the others.
Yeah, no, I'm sure. And kind of last question here. Looking ahead, any particular industries or themes you're particularly excited about, or you think that investors really aren't paying enough attention to yet?
That's a good question. Obviously, the answer everyone's going to say is AI,
Hmm.
but I think there's more to it than that. We're seeing a lot on the power side, uh, natural gas, power generation. There's a lot of opportunity there. Uh, we've written about it a lot in our newsletters, where you can think about it, and you could think about something like AI in the sense of NVIDIA and OpenAI and Microsoft and Google. What we think is more important is how are even these small companies just implementing these technologies on a day-to-day basis, using them as tools. So they're not AI companies, but they're using that tool to improve the efficiency of their business. And we're seeing it in margins. We already are seeing margins start to improve in these companies. So I think that's where it's exciting is an industrial small cap that people wouldn't realize is starting to implement some of these things, and you're starting to see it in margins. So you'll that the profitability side. Um, what gets us excited is just kind of how cheap a lot of these quality small growth companies are, right? Where you compare them to large cap, they're extremely cheap. Well, they're cheap independently of that, but especially compared to large caps right now. So, maybe people don't care at the moment, and the Mag 7 and all these private AI companies are all the rage, but we think there's a lot of opportunities on the small cap side.
I totally agree, and I think that's a great answer. Well, thanks again, Jesse, for joining us. You can learn more about him and Donville Kent by visiting their website, donvillekent.com. Thank you all for tuning in to another episode of Small Cap Insights podcast. If you enjoyed today's conversation, please visit www.darrowir.com for some more insights. See you on the next episode, and thanks again, Jesse. Appreciate it.
Yeah, thanks, Jack. Thanks for having me.